This stock fell, even while the business improved. Most investors assume bad performance means a broken company, but sometimes the opposite happens. Today, we're breaking down a global animal health giant whose revenue hit $9.5 billion. Margins expanded, buybacks accelerated, and the stock still struggled. So the real question, is the market warning us or missing something? Let's analyze the numbers, not the hype. The market versus the business. When a company underperforms in the market, people usually assume demand collapsed, management failed, growth is gone. But occasionally, the stock falls simply because expectations were too high. That's the case many analysts are debating right now around Zoetis, one of the largest animal health companies in the world. The company sells medicines, vaccines, and treatments for pets, livestock, and veterinary clinics globally. The market expected strong growth. Instead, growth slowed. But here's what makes it interesting. The business itself kept improving. The actual numbers for fiscal year 2025, revenue $9.5 billion. Adjusted earnings growth, approximately 8%. Gross margin, 83.5%. That margin expansion matters because margins tell you whether a company is gaining efficiency, not just selling more. Even with slower revenue growth, higher margins supported profit growth. Quarterly performance also slightly exceeded analyst expectations. Revenue beat estimates. Earnings beat estimates. So why didn't investors reward it? Forward guidance. Markets price the future, not the past. Why guidance moves stocks? For 2026, the company guided roughly around $10 billion revenue. Not bad, but not explosive, and when expectations are high, good can feel disappointing. This is a classic expectations reset. The stock wasn't reacting to collapse, it was reacting to a change in growth speed. Where growth is actually coming from: 1. International livestock demand. Globally, protein consumption continues rising as countries develop economically. That increases demand for animal health products. International livestock grew faster than U.S. markets, a structural trend, not a short-term one. 2. Companion animal treatments. Pet care spending remains large but has normalized after pandemic peaks. Veterinary visits softened slightly in some. Demographics, especially younger consumers facing tighter budgets. That doesn't eliminate demand. It shifts timing. The product pipeline. The company reports a large development pipeline, potentially up to 12 products, capable of major annual sales. Areas under development include treatments targeting kidney disease, oncology, cardiology, anxiety, metabolic conditions. In healthcare businesses, pipelines matter because they determine long-term revenue, not next quarter's revenue. Markets often undervalue future products during slow growth periods. The risks. Every investment thesis has risks. Reduced vet visits in some regions. Competitive treatments entering the market. Regulatory approval delays in certain countries. Currency fluctuations affecting global revenue. These risks explain cautious forecasts. But cautious forecasts don't automatically equal declining. Business fundamentals, valuation context. Valuation changed significantly. The company's earnings multiple fell to roughly 18 earnings, far lower than prior years. Lower expectations reduce upside pressure, but they also reduce downside risk. In simple terms, the market now assumes slower growth. so future surprises could matter more than past performance. The real debate, the real question isn't, is this a perfect company? It's, are expectations now lower than reality? Because historically, long-term returns often depend less on business quality and more on the gap between perception and actual performance. The company continues growing, maintains strong margins, invests in future treatments, and returns capital to shareholders. But growth is slower than the market once expected. So investors must decide, is this a mature business stabilizing, or a future grower being temporarily discounted? Time and execution will answer that. This video is for educational purposes only and not financial advice. Always do your own research before making investment decisions.